What was the Glass-Steagall Act? Financial regulation history. Have you ever wondered how the banking system in the United States became what it is today? One major turning point was the Glass-Steagall Act. This important piece of legislation, officially known as the Banking Act of 1933, was created during the Great Depression to reform banking practices. Its main goal was to separate commercial banking from investment banking. Before this act, banks could mix ordinary deposit-taking and lending activities with securities underwriting and trading. This blending created risks that put depositors' money in jeopardy. The Glass-Steagall Act aimed to reduce those risks and prevent conflicts of interest that had played a role in the financial collapse of the early 1930s. Another key feature of the Glass-Steagall Act was the establishment of the Federal Deposit Insurance Corporation. This government agency provided insurance for bank deposits, which helped protect consumers' savings. With this insurance, depositors felt more secure knowing their money was safe, even if a bank failed. This was a revolutionary step in banking regulation at the time. The act was sponsored by Senator Carter Glass, who had previously served as Treasury Secretary, and Representative Henry Steagall, who was the chairman of the House Banking and Currency Committee. Glass focused on the separation of banking types, while Steagall advocated for deposit insurance. President Franklin D. Roosevelt signed the act into law on June 16, 1933. For many years, the Glass-Steagall Act shaped the U.S. banking system. It clearly defined the roles of commercial and investment banks. However, starting in the 1980s and 1990s, many of its restrictions were gradually weakened. The most notable change occurred with the Gramm-Leach-Bliley Act of 1999. This legislation repealed key provisions of the Glass-Steagall Act, allowing commercial banks, investment banks, securities firms, and insurance companies to operate together once again. Some economists argue that this repeal contributed to the financial crisis of 2000. By allowing financial institutions to engage in riskier activities without the regulatory separation, it created an environment that led to significant financial instability. In essence, the Glass-Steagall Act was a foundational law in American financial history. It sought to create a safer banking environment by separating commercial and investment banking and introducing deposit insurance. The repeal of this act marked a major shift in financial regulation, with lasting effects on the banking industry and financial markets. Understanding this history helps us grasp the complexities of today's financial systems and institutions.